Calculator. Today we're going to go through some live mortgage rates and then we're going to do a deep dive into 2 to 8 unit mixed use DSCR loans. Great product here. We'll go into a deep dive shortly. We'll wait just a couple of minutes to get started here. Let us go live on all the platforms, but we did put the chat up on the screen. So anybody tuning in, feel free to drop a comment there as you pop in. We appreciate everybody tuning in nice and early. We'll wait until we go live on all the different platforms and wait for everybody to have a chance to tune in. Looks like we got some comments rolling in already. Appreciate that. Keep dropping comments as we go through the training here, and feel free to drop any questions you have as well. We'll get started in just a moment here. All right. Thank you for all the comments there pouring in. Love it. All right, it looks like we are live on all the different platforms, so we can go ahead and get started. As you tune in, please keep dropping comments in there. Let us know you're here checking in, and then also feel free to drop any questions you have when we do our deep dive topic. Welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. What we do on this show every morning is go through some live mortgage rates, and then we do a deep dive into a different topic. Today's deep dive is something we're very familiar with here because we specialize in non-QM loans, and DSCR loans are one of our favorite products. So today we're going to do a deep dive into 2 to 8 unit mixed use DSCR. Again, this is one of those great tools to have in your tool belt as a loan officer. So our sales manager, Jose Gonzalez, with 28 years of experience, is going to do a deep dive into 2 to 8 unit mixed use DSCR loans. But before we do that, let's do what we do every morning, which is pull up the pricing tool and go through the pricing. So Nick, if you're ready, let's go ahead and pull up the pricing tool, see what the market is looking like this morning for the rates.
All right, let me switch my screen and we will check it out. So this is our pricing tool for our team of mortgage professionals. This will show us the general rates and the APR for today. It is September 27th, just after 11 a.m. All of our general programs are live. If you'd like a full loan estimate with all of the fees that go into the APR, please get with one of our team members and they can send you a full breakdown in 24 states for primary loans. And we can do our business purpose DSCR, our topic for today, in 44 states. So for the demos here, we'll set up the same scenario we do every day, 400,000 loan amount, 80% loan to value, 20% down payment. We'll set the desired price to 99, means we're going to ask the computer to find the best rate at one discount point cost. We'll check out conforming conventional programs, then we'll go into FHA, and then we'll check out expanded guidelines, also known as non-QM, where we have over 5,000 additional loan programs beyond the regular ones here. We also have VA and USDA. VA is only for eligible vets and active service members. If you are eligible, let us know. We can quote it in a couple clicks. And USDA is only for eligible properties. If you do happen to be shopping in one of those areas, let us know. We can quote it in a couple clicks. Here is the conforming is where we'll start. We'll do a purchase, 30-year fixed loan, primary occupancy, single-family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos, we use an estimated FICO score of 760, an estimated debt-to-income ratio of 40. So let's see what the conventional rates are looking like this morning. And they're going up. Awesome. So best option today, 7.5 rate, 1 discount point in cost. That's our final APR at 7.667. So the rates are going up here due to the markets. Hopefully we see some downward movement soon. Now, for any reason our customer doesn't qualify for conventional, the next option we want to check out is FHA. FHA allows a little more leniency on credit as well as a much higher debt to income ratio. However, we'll keep everything exactly the same so we can compare the programs side by side. And the best option for FHA this morning, 6.75 rate, 0.8 discount points in cost, for a final APR of 7.336. So you see FHA is a little bit cheaper in this scenario for our customer that qualifies for both. Definitely check out the FHA options, especially as the rates are going up. Looks like FHA is a little bit better deal here. Now, if our customer doesn't qualify for FHA for any reason, many other banks or lenders may have to deny that borrower. But that's where we come in here at the Mortgage Calculator, where we have over 5,000 other options here under Expanded Guidelines. So when we select this box for Expanded Guidelines non-QM, we can choose a new income option. So instead of full doc, which is what we use for conventional and FHA, we can select an alternative such as asset related, business bank statement. Our investor DSCR is only for our DSCR, which Jose is going to talk about shortly. Personal bank statement 12-month is what we use for the demo. That's the most popular. We also have RSU, stated income, VOE, 1099, P&L, no income CDFI, all kinds of options here. The most popular is the 12-month bank statement for our self-employed borrowers. Many times it's those self-employed borrowers, when they submit 2 years of tax returns, may not qualify at all, or just may need to get a little bit extra income to get the home they really want. So we'll solve that problem by doing no tax returns at all, just the last 12 bank statements to determine a debt-to-income ratio using just the cash in the bank statements, no tax returns at all. Many times our self-employed borrowers, when they use this method, will qualify for double or triple the income and can therefore qualify for the home they really want. So with these basic settings, let's check out the bank statement options this morning. And best option here at the top, 7.5 rate, 2.875 discount points in cost. So there's typically more cost for these non-QM options. With the final APR, 7.629, is actually, again, beating conventional, looks like today. So non-QM, right there with conventional, and or could possibly beat it in some cases. Definitely recommend all of our borrowers out there to check out the non-QM options, especially when the conventional rates are going haywire. Now let's go back to our pricer here, and we'll check out a couple demos for investment properties as we do every day. So we'll do our last two live pricing for investments. Set up the same scenario, 80 LTV, 20% down payment, and we'll compare our conforming conventional options with the Expanded Guidelines non-QM. Remember, the government programs do not work for investment properties. So we'll select conforming conventional. Everything will stay exactly the same as our other demo. The only thing we've edited is the occupancy. So let's see what adjustments the conventional programs have for investment. The best option here at the top, 7.875 rate, 3.25 discount points in cost, for our final APR of 8.117. So a decent option there for a customer that wants to qualify conventional. However, these discount points are pretty steep. 3.25 points is $13,000 in this example. So most of our investors want other options. That's where we love to quote the non-QM options. So for the final live pricing demo, we'll set up investment again, 80 LTV. And this time we'll choose Expanded Guidelines, aka non-QM. So the first thing we must select is income. The most popular option by far is our DSCR option, also our topic for today. So DSCR stands for Debt Service Coverage Ratio. No income or employment involved from the borrower. We simply use the estimated rental income from the property to determine the DSCR ratio. If the estimated rents can cover the PITIA of the mortgage, that's a ratio of 1.0 or higher, aka the property cash flows. We even have options for ratios under 1, where the property doesn't quite cash flow on a monthly basis. For the demo, we always put 1.5, which is the highest value that the system takes, so we can see all the options. And the final thing is a prepayment penalty. 3 years is what we always select for the demo. We can select 0. That will cost more and limit the amount of programs that show up. We could also select 5 if we want, but that will, again, limit the amount of loan programs. So 3 years is the most common. So that is what we use for the demo. So with these settings, let's check out the DSCR options. And they've gone up a touch, but again, not quite as violently reacting to the markets as the conventional has. So best option here, 8.25 rate for 0.85 discount points and costs, puts our final APR at 8.312. So just a touch above conventional here, almost identical, but we've solved our borrower's problem. Instead of $14,000 almost in the example there. Here, $3,400, much more reasonable. So I'd say most of our investors, 90+%, when they compare these two side by side, will typically select a DSCR option for a multitude of reasons. Now you'll see we have a ton of different options here for DSCR as well. Some of these may allow things like credit events, foreclosures, bankruptcies, things like that are a little bit higher rates of costs. Some may allow us to use short-term rental income. And to segue into Jose's topic, some of these, obviously I can't price them live, do allow some specialty types of properties. So let me switch my screen. And we'll talk about a very special version of our DSCR product, which allows for small mixed-use properties. So 2 to 8 unit mixed use. Obviously, you can't have a 1 unit mixed use. It'd have to be 2 units to be a mixed use. That are mostly residential. Typically, these programs are for over 50% of it being residential, but does have a component of some type of commercial use, typically some office, retail, very light usage. Obviously, we're not talking about an industrial, warehouse or plant with an apartment above it. These are what you would consider mostly residential, and therefore we can then classify them into the same category as our standard DSCR residential loan products. So these are what would normally be considered a commercial property, because anything that has any commercial component, even if it was less than 50%, is still a commercial property. It's not a residential 1 to 4 unit. So these are outside of the normal scope. However, we have programs that have brought them back into the fold as a standard DSCR program, like we just presented. However, only a few programs allow us to use this property type and obviously have their own pricing and terms within that. So, Jose, if you're ready with your examples, let's have you go ahead and pull those up.
Good morning, everybody. Great to be with you this morning for Daily Rates Live with the Mortgage Calculator. Our 2 to 8 unit mixed use product is a very unique DSCR option. It is basically a hybrid of a commercial program for this type of property. This is a small residential multifamily, but the specialness of the program, how we're doing it here, is that contrary to commercial options, we are not really going to be honing in so much on the zip code and the MSA, but rather it is going to be reviewed just like every other DSCR residential property 1 to 4 unit is. Going to look at the appraisal, credit, all those other factors. The only special requirement for this product is that at least 50% of the space has to be residential in nature, and the other 50% could be commercial. However, we're not really looking for things like automotive or manufacturing, for example. Looking for more clean type businesses such as professional office or retail.
And when you say space, we mean units, right? So
yes.
2 units means 1 residential, 1 commercial.
Correct.
3 units would have to be 2 residential, 1 commercial to be greater than 50, right? So the math is going to be based on units. So just
Correct.
wanted to clarify there.
Yes. So to get a little bit more into the nitty gritty, the residential, it has to be a 2-story structure for this particular option that we're talking about, at least a 2-story structure, because the residential and the commercial component cannot all be on the first floor. They're looking at residential to be at least on the second floor and the commercial to be on the first floor. So let's get into our purchase options here. You're going to find that the rates that we're going to offer with this hybrid type product is probably like 2% lower than what you would find for a for the same type property if you were to go full commercial. And then on top of that, you're going to have to be dealing with the zip code and the MSA situation. Whereas the only thing we really got to worry about here is that the property not be designated rural per the appraisal. So in our first option here, we're looking at a 760 plus credit score. At 760 or above, there are no loan level price adjustments. 75% LTV is the maximum for this product. Minimum DSCR for this product is 1.1, and it does require a 5-year prepayment penalty. They do not allow any prepayment less in duration than 5 years. So there are multiple rate options here. What I basically did is take the one more or less in the middle. So here in this example, we're looking at a $450,000 loan on a $600,000 purchase. So the rate we're looking at here is 9.625, and that's roughly 1.75 points. Now, for each, for each 0.125% in rate adjustment, either down or up, it is approximately 0.375 points in cost. So you can do the math if you want to play around a little bit with the rate, up or down. But like I mentioned, I chose the one that was pretty much right in the middle of the table at 9.625. Now, keep in mind something very important also. This is a similar product as the 5 to 8 unit small multifamily DSCR product, except this one, since it is mixed use, does have a loan level price adjustment of over 2 points. So were this our 5 to 8 unit, you could see that the rate 9.625 would be pretty much par for this DSCR. But again, what we're doing here is the 2 to 8 mixed use, which is a little bit higher risk type property due to the commercial component, hence a little bit higher cost on the rate. So now 740 to 759 credit score, it does increase a little bit in the cost, whereas this one had roughly 1.75. This one is about 2.25, more or less, for the rate, 9.625. The important thing is you're still getting 75% LTV at a 740 to a 759. Now we have 720 to 739, which is 720 is the lowest credit score at which you can still reach 75% LTV. So I did keep the rate on my examples here, all the same rate, just so that you could compare the effect of the FICO score on the cost of the rate, because it's really all about the cost of the rate, not necessarily the rate. All depends how you want to look at it. We have the same rate, it's just going to cost a little bit more because at the lower credit score, it is higher risk, hence a little bit higher cost. So we are able to get 9.625, but whereas over here was costing us 10,125, over here is costing us 12,938. So now we have our purchase quote 700 to 719 credit score. Now below a 720, the LTV does drop to 70%. So that is the big impact here. It is not possible to reach 75% below a 720 with this option that we have, which is our lowest interest rate option here We do have some other options, but they're like 2% higher rates. So here we're looking at 9. Now remember, this is at a 70% now, not 75s, and I kept the rate the same. So here the cost does drop a little bit to 10,688, but that is because now we are at a 70% LTV instead of a 75%, a little bit lower risk due to the lower LTV. And now we have a 680 to 699 credit score. Again, our LTV drops now to 65% LTV. It is the maximum LTV that is possible for a 680 to a 699 credit score. We kept the rate the same, 9.625, but now you see the cost does drop to $7,800. So if you wanted to keep the cost the same as, let's say, the first example, which was 8438, you would probably more or less would be the same. I don't think you would be able to drop to 9.5, and you can, but 0.375 of 390 would be roughly $1,300. So it'd be a little bit higher than the cost at the maximum LTV at a 760 or above. But still here, good rate for a 680. You can go 9.625 at a 65% LTV. I can guarantee you this is a lower rate at this credit score than any of the other options that you would have out there for this mixed-use product with much less complications on the approval. Oh, one other thing I didn't make note on this product, it does allow first-time investors as long as they have a primary housing expense for the last 12 months. So that's a little frosting on the cake there. And our last example, which is our lowest credit score that is possible on this program, on this option, 660 to 679. So we are able to go all the way down to a 660 credit score at a 65% LTV for this mixed use product, which is pretty unbelievable. Now, obviously, rate is a little higher, 10.375. However, I will tell you the following. This rate at 10.375 at a 660 is lower than most of the other options have at a 740. So keep that in mind. So 10.375, the cost is just a little bit over 2 points. And again, 660 to 679 credit score at 65% LTV.
All right, great. I don't see any questions, but I just really want to reiterate, because I know there's some people probably that are new on here, and probably some people who are new to commercial. Just one of the amazing things about these programs is that they can't discriminate against where this property is. And for those of you familiar with the commercial world, that's a huge issue, especially a lot of these properties that DSCR well, they're going to be in areas where a commercial lender probably wouldn't touch, right, Jose? These areas where the market's not going to be big enough, there's not going to be enough stuff there to pass the snuff of the commercial lenders.
Totally
right?
True. I mean, that is probably, besides the amazing rates, right? That is probably the most positive feature of this DSCR option, is that it is analyzing these properties as if they were 1 to 4 unit DSCR, as far as not looking at the zip code and all the other factors that the commercial lenders tend to look at when sizing up a deal.
Because when you go over 4 units, you're commercial, right? And you're going to have to deal with all of that stuff typically, but that's why these programs are so amazing.
Absolutely.
All right. Well, I think we can go ahead and wrap it up. Remember, we do this show 11 a.m. Eastern every single weekday, where we go through the live rates and then do a deep dive into a different topic. We'll be right back here tomorrow with a new topic to talk about. So thank you, everybody, for tuning in. Thank you, Nick. Thank you, Jose. We'll see you tomorrow, 11 a.m. Eastern, for the next episode of Daily Rates Live with the Mortgage Calculator. Have a great day, everyone.
Thanks, everybody.
Thank you, everybody.